What happened over the weekend, Hurricane Florence, not only a natural disaster for the Carolinas, but also it's becoming a financial one. A majority of residents do not have flood insurance to help offset the cost to rebuild. We've seen this play out over and over, and insurance companies could get slammed as well. Estimated insured losses from Florence in the range of $3 to $5 billion. They could go as high as $20 billion. Let's bring in Ian King, senior analyst at Banyan Hill. Ian, good morning.
Good morning, Cheryl.
We talked about this as we were going into the storm last week, that only about 3% in North Carolina and about 9% in South Carolina, those coastal residents, had federal flood insurance. So it looks like this is going to be a burden, not only on the insurance industry, but also the U.S. taxpayer.
Right. So thankfully, from last week, the assessment of how much damage there will be from the storm has been downgraded significantly. Originally, the storm was supposed to be hit. It was supposed to hit as a Category 4. It hit as a Category 1. The storm was supposed to have $170 billion worth of damage. That was downgraded to $20 billion. So I think the impact there has been greatly reduced.
Okay, well, you know, as far as cost of hurricanes go, this certainly is not going to be the costliest hurricane. That, of course, goes to the deadly storm that was Katrina a decade ago. Hurricane Harvey, though, $125 billion. Maria, $91 billion. And then Sandy up here in the Northeast, $68 billion. We don't really know what the overall cost is going to be, but we have to watch these insurance companies today, because remember, in particular, Allstate. I remember during Katrina, shares of Allstate dropped like $10.
Right. But insurance companies are now in a better financial position than they've ever been before. They're sitting on about $500 billion worth of capital. And the reason for this is that insurance products are a very good investment because they're not correlated to the stock market's returns. So if you're a pension fund or a hedge fund, you can invest in insurance companies, insurance-linked securities, such as reinsurance bonds or catastrophe bonds, and you have exposure to the insurance sector without actually having to buy the stock. So this gives the insurance companies much more capital than they had 15 years ago.
Interesting. That's a really good point about that $500 billion number. I'm glad you brought that up, actually, Ian. And also some of the insurance companies that are going to be affected, and this really is according to J.P. Morgan, the ones to kind of watch. And hurricane season's just beginning, just to be clear. So this could be a story that we have to revisit. But Renaissance, Travelers, I mentioned Allstate a minute ago, Chubb. I mean, these are all kind of the names to watch. Of these names, are there any that you really like in particular that you would recommend either buying a bond on or buying the stock itself?
I think Allstate's in a very good position here. Obviously, they have more exposure to the property casualty market than AIG does, but they don't have that same financial products risk as something like AIG. So I recommend Allstate here. You saw a little bit of a pullback in Allstate shares last week. It dropped about 2% when the storm was minimized on Friday or reduced to a Category 2, then Category 1. Yeah. Shares of Allstate actually rallied into Friday's close. So
yeah, if you look at the one-week chart, Ian, if you look at the one-week chart, actually, that is exactly what happened. The timing, it's very clear. We're going to leave it on this chart. Something for our viewers to think about as we open up for trading this Monday. Ian King, thank you very much for being here, Ian.
Thanks for having me, Cheryl.